When you're investing in property, whether to go for cash flow or capital growth can be a hotly debated topic. Our next guest says there is a middle ground where you can have your cake and eat it too. Michael Sloan left school at 15, spent many years as a painter and decorator before becoming a successful property investment expert. He's just released his second book, The Formula to Successful Property Investing, and he joins us now from Melbourne to have his say on this debate over cash flow and capital growth.
Good morning.
It's often something that we focus on, Michael, isn't it? I guess, though, firstly, just to the book, you've aimed this at people on an average income. You say that you can invest in property on an average income.
Well, you can. Obviously, not everybody can buy an investment property, but there's a lot of people out there talking about the affordability crisis who actually could invest. And there's a lot of parents that can help their children get into the property market who don't actually realise that they can do that in a relatively simple way.
The trick seems to be, Michael, in your book, deciding for what reason you are doing this investment, if it's for immediate cash flow or for negative gearing or both.
Yeah, and look, and to me, the balance is the right approach. A lot of people chase one thing or the other. When people talk about high cash flow, they're often talking about the heritage in the city. High capital growth. They're talking about the heritage inner city properties, and they're just unaffordable for a lot of people. Also, the cash flow on those properties is just terrible. So even people on high incomes that buy those properties, you know, you can have a high income, but you can have a lot of expenses as well. You can have private school fees and a large mortgage and a car loan and so on. So it doesn't mean you've got much disposable income. But buying the wrong kind of property with a really negative cash flow can have a serious impact on what you're doing, and a lot of people end up selling those properties at a loss fairly quickly after they buy them, even though fundamentally they're really good properties.
Just, I guess, going back to basics, I know a lot of viewers will know what cash flow and capital growth is, but for those who are starting out and new to this, maybe these terms aren't familiar. Can you just explain what they are?
Sure. So cash flow is effectively how much is a property going to cost you or make you every week after tax. So you have your income, which is your rent, and then you have tax breaks, and then you have all the outgoings on the property. So is that property going to make you a profit or a loss? So that if a property is going to make you $20 a week, we might say it's $20 a week positive cash flow. If it loses $20 a week, it's $20 a week negative cash flow. And we talk a lot about negative gearing, and you get the same tax breaks on a property that ultimately is positive cash flow or negative. So you still get negative gearing in both ways.
But you've got to survive the whole year until tax year comes around.
You do. Well, particularly that's something for self-employed people to be really careful about. If you're a pay-as-you-go taxpayer, you can have your tax breaks every month, which helps with the cash flow. But self-employed people, they have to wait until they get their tax done. So before tax, a property might be negative $9,000 or $10,000 a year. Now, if you want to buy a few properties, build up a portfolio, that means you've got to carry $30,000 a year before you get your tax done. And for self-employed people, that can be tough. So they buy themselves a good property that after tax makes them a profit, but they've got to survive until tax time.
Living on Weet-Bix. Living on Weet-Bix and tea until then.
And another of your key tips then as well for people looking at or where people investing go wrong when it comes to cash flow and property investing is not knowing the cash flow. And you say this isn't something simple that you can just jot down on a bit of paper yourself. You really need to get an accountant, and an accountant with property investing experience to do this for you.
True. You do. It's amazing how many accountants I speak with. The first time they know their clients have bought an investment property is when they do their tax. And really, that's too late. You should be engaging with your accountant. There wouldn't be one property investor in 10 that understands what the cash flow is before they buy the property. That's why so many people sell so quickly. The average time a property is sold for on the market at a loss has been held for 5.9 years. That changes all the time, but it's about 5.9 years. And that's because people, I think the main reason is that people don't understand the cash flow before they buy. They don't run the figures past their accountant. And if you talk to a typical real estate agent and ask them about cash flow, they don't know what you mean, because it's not their job to tell you what the cash flow is. They're acting for the vendor. So you need to get all the information you can about that property, send it to your accountant, get them to run the figures for you. And if they can't do it, you've got the wrong accountant.
Well, that leads to the question, because I know many people don't have accountants. They really don't.
They don't, or they have someone that does their tax.
Yeah, different thing.
As soon as you own an investment property, you're taking things to another level. And you're really starting a small business. You're starting a small investing business. And if you're going to do that, you need to surround yourself with a team of experts. You need to find an accountant. You might need a quantity surveyor. Well, you will need a quantity surveyor to get your tax breaks. A financial planner. I mean, if you can't afford income protection and life insurance, you can't afford to buy an investment property.
Yeah.
You can't put yourself in a vulnerable position. And that's what happens with a lot of people. So you need a team of experts to surround you.
Just on those 9 out of 10 that didn't know the cash flow before they bought, and now they've got a property that has awful cash flow but potentially high capital growth, is there any way you can, balance that and improve the cash flow?
There can be, and it gets down to talking to your property manager. Sometimes even furnishing a property and letting it out as a furnished place can make a big difference to the cash flow. You can also have a look at your loan structure, make sure you've got the right interest rates and so on. So there can be, but you've got to run the numbers before you get that far if you can. But there are a bunch of tips in the book about things that you can look at anyway.
Yeah, it's a well-written book. It's so easy to understand.
Yeah.
I don't claim to be smart with money at all. Bridie, yes.
No.
Me, no.
No.
And it's a good book. It's worth getting a hold of this one.
Yeah, absolutely. And I guess just final point is, and I thought this was so interesting too, is don't ignore debt reduction. It is. So what would you do though? Because this is my big thing always. Do you pay down the investment property first, or do you concentrate on paying down the home? Where do you get the best benefit?
It's a really good question. Look, there is a section in the book. If you have a large disposable income that you can put towards your home loan every month, there is a time when maybe you should take some of that away and put it towards the investment debt. But generally, most people don't have that kind of spare cash. So what I always say is debt reduction is guaranteed wealth creation. Run some figures, there's a lot of debate about people buying coffees every day and smashed avocados and things like that. But if you have a look at, if $50 a week is what you're spending on coffee, have a look at how much $50 a week is going to save you on your mortgage. And you'll find it's tens of thousands of dollars. So then you have to make a decision, an informed decision. Do I want to save $50, $60 or even $100,000 on my mortgage, or I'd rather have a cappuccino instead of making a coffee when I get to the office?
Yeah.
Oh, exactly. Not to mention your MasterCard bill. But maybe that's just me.
No. Michael, really appreciate you joining us this morning. Thank you so much for that.
Thank you.